G'day and welcome back to what will be probably the most complex part of the discussion. Income tax is definitely complex. The investing side is very complex but very subjective. Capital gains tax, very technical, a lot of set rules. So I'll go through, and what I'm hoping to do here is really just give you an idea of what to look out for. What are some of the tricks that accountants use to help? Well, they're not tricks, they're well within the legislation and the rules. What can you use to make sure that you minimise capital gains tax as much as possible? So this will give you a bit of an idea on what to look out for, and working with your accountant, it will be a really good, I suppose, a kickstart to those conversations. Again, here is our general advice disclaimer. Please pause, have a read. This is general advice only. So, capital gains tax, minimising potential capital gains tax. It's a great problem to have. So I think if any of my clients have a capital gain, that's essentially what we're after. We're after nice income to do the things we want to do, and if the assets that we buy, the businesses we buy, grow in value, that is essentially what we're chasing. And the tax rules for capital gains, particularly for those that run a business, actively run a business, are extremely complicated. The timing of the purchase is obviously critical, and obviously any asset purchased before the 20th September 85 is exempt from capital gains, and anything after that is subject to capital gains. So there's one general exemption that we all get. So when you've purchased an asset after 20 September 85 and it's been held for more than 12 months, everyone gets the access to the 50% discount. So the capital gain is halved. So a $10,000 capital gain on any asset that you've held for more than 12 months will be halved in value. So you only pay capital gains, or that half amount, the 10,000 down to 5, that $5,000 is included in your taxable income for that year. So any asset that's sold within the 12 months, the full $10,000 would be included in your taxable income. Now this is obviously the small business capital gains concessions for business owners, for farmers, for any business. Extremely complicated. I'd recommend that obviously you seek advice from an appropriately qualified accountant. Some accountants are better than others because it's really complicated. I know it reasonably well, but always get the sign off from an accountant. So individuals that run a business and they meet certain criteria, such as business valuation or the income turnover limits, can be eligible. So you only need to be cover off on one of these, that if you've got turnover less than 2 million or have net assets of no more than 6 million, this excludes personal use assets such as your home. I think superannuation is not included. So this is where it gets really deep and quite technical. So you just need to qualify for one of those, not both. And some of the small business concessions that you can use, obviously the 15-year exemption. So this is where the time of the ownership is absolutely vital, and how long it's been an active asset for within the business has a broad bearing on which exemptions you can use. The gold standard is when you're retiring is the 15-year exemption. There is the 50% active asset exemption, and obviously that's the in addition to the general 50% as well. Then there's also the 500,000 retirement exemption, which you don't need to retire from. So this is where it just gets confusing, gets complicated. There's also the rollover exemption, where you sell one active asset and you've got a couple of years to potentially roll that over into another active asset. So selling one business to buy another. So the 15-year exemption example, obviously if you meet the two basic ones, you've continually owned the active asset for 15 years, you're over 55 and you're permanently retired or incapacitated, you'll essentially be no capital gain. It's part of a retirement. The 50% active asset reduction and the 500,000 exemption, well, if you've been obviously meet the basic criteria, obviously the asset and the turnover test, you can have an extra 50% on top of the general 50% exemption, and it allows you to reduce the capital gain by another 50%, and it's in addition to the general 50%. Sometimes we skip the active asset exemption, but you can't skip the general 50% exemption, and that helps us to maximise the amount of money we get into superannuation, because these rules allow us some very generous ways to get a lot of money into superannuation. The $500,000 retirement exemption, essentially capital gains from the sale, that are exempt for a lifetime limit of $500,000. And if you're under age 55, the exempt amounts after you apply other exemptions must go into superannuation. So as you can see, there's a fair bit happening here. It gets quite complex, but this is where your accountant and an advisor will be able to help you. As I mentioned before, there's a strong relationship between the small business capital gains exemptions and superannuation. So like many small businesses, farmers are obviously reinvesting back into the business. There's not a bucket load of free cash flow that may go into superannuation or off-farm assets. Using these business concessions can increase your superannuation contributions. So obviously the 15-year exemption is the gold standard. It allows you to get up to $1.5 million into superannuation in one hit on retirement. You can get the proceeds of the sale in. And this doesn't have to be cash, it can be land assets as well. So you might retire, sell some farm, but not all the farm. So the farm that's not sold, some of that can potentially go into superannuation and leased to a third party. So there's lots of strategies, lots of complexity. And obviously both these types of contributions are in addition to your normal concessional contributions, the $25,000 the one that reduces your taxable income, and the non-concessional where you're using after-tax money. So it's in addition to that. So thank you for listening. That was probably about as complex as the tax side's going to get. It's an overview only, but it's a bit of a guide just to help you take the next step of understanding, so you can be guided with some knowledge by your professional accountant who understands this area well. Thank you for listening, and next video we'll look at is what do you do with the proceeds after a sale. Thanks for listening.